Ever wondered how inflation and interest rates might be playing a role in your stock market investments? Well, you're not alone. It's a question that puzzles many. These two economic factors are like the invisible hands that subtly shape the financial landscape and, by extension, your investments. Let's start with the basics. Inflation, in simple terms, is the rate at which the general level of prices for goods and services is rising. It's like an invisible thief, gradually eroding the value of your money over time. On the other hand, interest rates set by the central bank are the cost of borrowing money. They're the heartbeat of the economy, influencing borrowing, spending, and saving behaviors. Understanding the dance between inflation and interest rates is crucial for investors. It's like knowing the rules of the game before stepping onto the field. Diving deeper into this topic will shed light on how your investments can be influenced by these two economic factors. Inflation, the general increase in prices over time, has a sneaky way of impacting stock markets. It's a bit like a slow-moving storm cloud, seemingly harmless at first, but capable of bringing a deluge that can change the landscape. To understand this concept, let's consider the correlation between inflation and stock markets. When inflation is high, the purchasing power of money decreases. This means that the same amount of money will buy less in the future than it does today. Now, this is important for investors because the value of a company's future cash flows, which is a key factor in determining a stock's price, is reduced in real terms when inflation is high. Historically, this correlation has been evident. For instance, during the inflationary period of the late 70s and early 80s, stock markets struggled and many companies saw their stock prices plummet. Companies that relied heavily on future cash flows, such as those in the technology sector, were hit particularly hard. Another example is the more recent period of high inflation in 2021. Companies that were considered stalwarts, like those in the retail sector, felt the pinch as their future earnings were devalued and their stock prices took a hit. However, it's not all doom and gloom. High inflation can also present opportunities. For instance, companies with strong pricing power, those that can pass on increased costs to their customers, can thrive during periods of high inflation. Companies like these usually have unique products or services that allow them to maintain their margins, even when the cost of raw materials or labor rises. So yes, high inflation can be a foe to investors, but understanding its impact allows us to adjust our strategies accordingly. It's about seeing the rain clouds and knowing when to find shelter, and when to dance in the rain. After all, the stock market isn't just about numbers and charts, it's about understanding the nuances and making informed decisions. Interest rates, another key player in the economic scene, have a significant effect on stock markets. You might wonder, how so? Let's dive in. Picture this. Interest rates rise. Suddenly, borrowing becomes more expensive for corporations. They need to shell out more to service their debts, which can eat into their profits. For instance, consider a company like XYZ Corp, which had a debt of $1 billion. When the interest rate increased by just 1%, their annual interest payments rose by $10 million. This substantial increase can lead to a decrease in their net profits, and as a result, their stock price could potentially take a hit. But corporations aren't the only ones feeling the heat. High interest rates can also impact where investors choose to park their money. If interest rates rise, bonds can become more attractive. Why, you ask? Well, bonds typically pay a fixed interest rate. So when interest rates increase, newly issued bonds come with higher interest payments, making them more appealing to investors. This can lead to a shift in investments from stocks to bonds. Remember the tech bubble burst in the early 2000s? One of the factors influencing the shift from stocks to bonds was the increase in interest rates. However, it's important to note that this isn't an absolute rule. The relationship between interest rates and stock prices is complex and influenced by a multitude of factors, including investor sentiment, economic growth prospects, and much more. So, while high interest rates can make borrowing more expensive and potentially make bonds more attractive than stocks, they can also signal a strong economy, which could boost stock prices. It's a delicate balance, and each scenario can play out differently based on the broader economic context. Interest rates, just like inflation, can be a double-edged sword, impacting both the corporate world and individual investors. Just like most things in life, high inflation and interest rates have their pros and cons. Let's dive right in. On the bright side, high inflation can sometimes translate to higher profits for businesses as they raise prices to keep up with increased costs. Investors in these businesses could potentially see greater returns. Similarly, High interest rates can mean more lucrative yields for those invested in interest-bearing assets like bonds. However, there are substantial risks. High inflation can erode the purchasing power of money. This means the same amount of cash will buy you less over time. On the interest rates front, when they're high, borrowing becomes more expensive. This can slow down economic growth, affecting businesses and, by extension, their stock prices. Also, keep in mind that high inflation and interest rates can create uncertainty in the markets, which can lead to increased volatility. Understanding these pros and cons can help us make more informed investment decisions. So, we've taken a journey through the world of inflation and interest rates and their impact on stock markets. We've discovered how inflation, a general increase in prices and fall in the purchasing value of money, can affect the overall economy and, by extension, the stock markets. We've also delved into how interest rates, set by central banks, can influence investment decisions and the performance of stocks. We've seen examples of companies that have navigated these economic conditions successfully and those that have stumbled. We've looked at historical data and current trends and discussed the potential future implications. And finally, we've weighed the pros and cons of high inflation and interest rates. We've learned that while they can pose challenges, they also present opportunities for savvy investors who understand these economic phenomena. Remember, a savvy investor is one who understands the economic landscape and uses this knowledge to navigate the world of investing. Thank you for joining this enlightening journey.